Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is December 30th. This is the probably the last time I'm going to see you guys in video format in 2025. Best wishes and best of success for 2026. Let's make it a great year, and I hope you all have a fantastic, super New Year's Day and New Year's Eve. And whatever you're doing, stay safe, take care of yourself, and we'll see you on the other side of 2025. The video I'm going to share with you today is the last installment of three. So I had previously done a couple of videos similar to this one, and those videos have been viewed about 12,000 times or so, which is a lot for a little channel like mine. So thank you very much to all the people who watched it, including the people who subscribed and turned notifications on. I appreciate that very much. It's good for my ego. But this is the last one of the three. So the first one was the top five US energy stocks you could probably buy right now. The second one was Canadian energy stocks because Canada is such a powerhouse from an energy point of view. And this one is the top five global energy stocks for 2026. Now, it's important to note here that I don't know anything about you, as I've mentioned before. So I don't know anything about your personal situation, your investment thesis, etc. So I'm using my criteria. And when I get to the ranking later on, I will tell you what I use for the purposes of ranking these global stocks. And in addition to that, it's super challenging to rank global stocks because it's very difficult to compare apples to apples, proverbially speaking, when you are trading in a global market because not everybody has access to the same type of equity instruments. So here's my agenda. So usually I don't publish an agenda, but just to help me because I'm getting old, I need to do this. So I'm going to tell you what I'm going to do here. And if you stick with me, then I'll take you all the way to the end to number six. But I'm going to try, even though I'm going to go slowly, I'm not going to try to keep you too long. My first slide will be the greatest top five global energy stocks, and then my revised list will come up next, and I'll give you a quick side-by-side comparison of my top five. Then I'll share a few slides with you, just saying the bulls say versus the bears say, a little summary. And I'm going to rank them from best to worst. And then to close off this video, I'm going to share with you a way that you can mitigate single stock risk with ETFs. Now, in the previous videos, many people responded to saying or asking, what about this one? What about this one? Right? So from a Canadian point of view, there's so many good stocks that you could buy. And I had the challenge of just picking the top five. So it's always difficult, and I'm probably going to exclude one of your favorites. So forgive me for that. And just bear with me as I walk you through this because you might find something of interest to you personally for your portfolio. So the top five global energy stocks, based on my criteria, and as I said, I don't know what yours is, are you can sort of view this almost in ranking order. Saudi Aramco, based in Saudi Arabia, is the world's largest energy company overall. Market cap well over $1 trillion. Shell, headquartered in the UK and Netherlands. Shell, one of the most profitable and largest integrated oil and gas companies on the planet. PetroChina, headquartered in Beijing in China. Total Energies in France, and BP PLC, formerly British Petroleum, a UK headquartered firm. Now, these are sort of, as I said, based on my criteria, the top five global energy stocks, which you probably could just buy right now, assuming you had the ability to do that. Now, I am a US tax person, but I'm also a multi domiciled citizen. In other words, I have citizenship from multiple countries. So even though I do have the ability to buy some of these, I appreciate and understand that not everybody has the same ability to buy pretty much any stock that you can buy. So what I did was I revised my list. I took a little bit of artistic privilege and said my revised top five is going to exclude those two. So PetroChina and Saudi Aramco. And then I'm going to include two of our fan favorites, which come up in discussion all the time. And those two are Ecopetrol and Petrobras in Brazil. Ecopetrol in Colombia and Petrobras in Brazil. Now, a couple of things to note on this particular slide here is that I can buy all of them on the New York Stock Exchange. So as a US tax person residing in the United States, I have the ability to go into my US brokerage account and buy them all on the New York Stock Exchange. If I wanted to buy them in one of my other international accounts, I would need to do something else or something different. But that's going to be unique to each and every one of you watching this particular video. At the bottom here, you can see all five of these are actually almost identical, except for the odd one out here, Total Energies on the far right, which is oil refining and marketing. The other four are international integrated companies. The other thing to note for the people paying attention, especially for the US tax persons watching this video, I highlighted in this orange arrow here, this little ADR, which means American Depository Receipt. If you reside in the United States and you buy these on the New York Stock Exchange, you are not actually buying the equity. You are buying an American Depository Receipt. Firstly, that means you're not actually buying the physical share of the company, but you're buying a paper asset which matches the shares issued by the issuer. And secondly, there are some fees attached to trading ADRs. They're not excessive, it's just a nominal fee. Depending on your broker, they may charge you like, $6 or $6.95 or something like that to buy an ADR. But then after that, of course, you own the stock. They're in alphabetical order. They're not ranked here. So BP comes first, then Ecopetrol in Colombia. So BP in the UK, Ecopetrol, Petrobras in Brazil, Shell, now headquartered in the UK, used to be headquartered in the Netherlands, and Total Energies, which is headquartered in France. So looking at the stochastic for the technical gurus out there. So quite simply, the stochastic, it means more than this, but just for the sake of simplicity, if the 20-day raw stochastic score is above 80%, it's overbought, and it's below 20%, it's oversold. So if you look at the row, second one from the top here, you can see the 20-day raw stochastic for all of them look okay, except for Total Energies at 87.7%. So based on the 20-day raw stochastic, Total has been overbought. So even though the analysts say buy it, you should probably hesitate and do a little bit more homework and due diligence before you jump in boots and all on Total Energies, which, by the way, is an excellent stock to add to your portfolio. The 100% sell here, which is unique, as you can see, because all these all these green lines here say buy, 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 buy. And then we have a couple of analysts saying today's opinion, previous opinion, 100% sell on Petrobras. Now, as a contrarian, if the analysts are all saying it's 100% sell, I might want to take a closer look at this one and potentially buy it, right? So that's just how I work. It doesn't mean I'm necessarily going to buy it, but I would certainly be willing to take a little bit of time, do a little bit of extra homework, and say, hey, you know what? If everybody is saying sell it, I am probably going to be the outlier and I'm going to be the one to buy it. From a price earnings point of view, which is always critical for you to look at, you can see that they are all well priced. In fact, the most expensive one, using the price earnings ratio as your benchmark, is BP at 12.6. But look at the low PE ratio, below 10 for Ecopetrol, Petrobras, and Total Energies. So they're all sort of priced to buy. So now you're probably wondering, so which one will be the winner? We'll get to that in just a minute. Here, what I'm doing is doing just a little bit of math. I'm looking at the third row from the top here. It says annual sales, and I'm dividing it by the market cap or capitalization. Market cap or market valuation means the number of shares outstanding multiplied by the current stock price. So if you look at the annual sales number over here, and I'll just use two green arrows here to tell you what I'm looking at. Third row from the top, it shows me that BP is generating approximately $194 billion in sales per year and has a market cap of, relatively speaking, only $90 billion. So if I take the annual sales and divide the market cap into it, I end up with a percentage of 216, which is actually quite attractive. In other words, it looks to me, based on this benchmark, as if BP is actually very cheap because it's generating an enormous amount of sales and its market cap by comparison is quite low. But how about this? Ecopetrol is generating about $146 billion in revenue on an annual basis, and its market cap is only $20 billion, which is 725% expressed as a ratio annual sales to market cap. The rest of them are quite normal, 122, 137, 123. That's pretty average, pretty normal, nothing weird there. At the bottom, you can see they all pay dividends. In fact, they all pay a really good dividend too. Your last ex-dividend date on these are in the past. They're all from 2025, which means if you buy it today, you are going to have to wait about a quarter, maybe a quarter and 1 month or so before you will get your next dividend payment. Now, it's not a bad time to get into energy, but I wouldn't jump in boots and all. I'd add in small tranches, maybe buy little bits at a time, and wait for the upkick, or whatever the word is, uptick, that's going to come sort of towards the end of 2026. Maybe it's sooner than that, mid 2026, but for sure towards the end of 2026 into 2027. When I interviewed Rick Rule the other day, he said he doesn't mind being early on energy while in the meantime he is socking away the nice dividends that many of these energy companies pay, including the five that are on the screen right now. If you look at it in picture form, here I'm looking at it year to date. Usually I look at it at a 1 year period, but today is December the 30th, 2025. So I can look at it year to date because it's almost the entire year. So there was a huge spike here for EcoPetrol at the beginning of the year, and then it kind of crashed. This big red arrow here was Donald Trump's Liberation Day when he announced tariffs on pretty much anything that moves, lives, and breathes. And everything crashed, including energy stocks, and then spiked up back soon afterwards. That crash was very, very temporary from memory, what, a couple of weeks or so. And you can see EcoPetrol was doing really, really well. It's the blue line up here. But the trajectory for most of them is the same, except for this outlier here, which is Petrobras. So maybe Petrobras, with all the analysts saying sell, 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 is now the thing to buy. All you need to do is allocate a little bit of time to do some homework and due diligence and decide whether this is right for you, whether it matches your risk profile, your investment thesis, and your projected rate of return. Main thing there is risk. How much risk are you prepared to take investing in something like Petrobras? You can see over here on the right-hand side underneath this green arrow, all of them have been performing really well, excluding Petrobras, which is actually quite impressive considering the fact that the energy prices over the past year have been so low, and the soft prices on WTI and Brent have impacted all energy companies negatively, but these guys have been doing well. And if you take any of these sort of in the 20 percentile range and you still add your dividend to it, which is often 4, 5, 6% on an annualized basis, you're getting close to 25 to 30% return year over year in a soft energy market. So imagine how these things are going to take off and fly when energy recovers from the stupid price it's trading at right now, which is under $60 for WTI and Brent's there or thereabouts as well. You know, we should not think that a price on, for instance, WTI at around 80, $85 is too far away in the future. Maybe in 2026, and for sure sooner than what you might think this will happen. Now, I'm going to look at the bull and bear thesis for each of these individually. So the first one, BP, because remember it's alphabetical. Now I have an unknown here because I don't know if this is bullish or bearish, but they've just appointed a new CEO, Meg O'Neill, and I'm sure Vicky Holub from Occidental Petroleum would be happy to see another lady take over the CEO dictatorship for a major energy company because women. And this would be interesting to watch because we're not sure if this is going to be a bullish or bearish indicator for the stock. So I just added it here as an unknown. Usually I would be bold enough to say this is good or bad or bullish or bearish. But in the case of Meg O'Neill, I simply don't know because I don't know anything about her other than what I read in the newspaper in terms of her being the best person for the job. I just hope that they paid her the same amount of money as the outgoing CEO or even more so that she can crash through the glass ceiling and make sure that women earn at least the same as men. The bullish thesis for BP is a strategic reset towards higher return oil and gas. They are ready for higher prices, and the higher prices will follow soon. What's nice about BP is that it has very, very good, strong operational momentum, good free cash flow growth, and a potential re-rating in the books or in the offing. It also pays a dividend of between 5 and 6%, and is doing continued buybacks as well. So there's a lot of things to like about BP. What's not to like then? Well, they have been unfortunately guilty of persistent execution risks and strategic pivots. In other words, nobody really knows what BP is doing. And as a result, the shares have just been lagging. There's vulnerability on that buybacks, on those buybacks, and there's also dividend pressure, of course, if the oil price weakens further. Now, I don't think necessarily that it's going to weaken further. It might drop to like, I don't know, in the low 50s or so, but beyond that, we're going back up again. So we're probably, I'd have to guess we're probably sort of near the bottom right now, but no one knows for sure, right? You can't predict these things. BP also has elevated debt, and they need to reduce that. And because of the uncertainty surrounding BP, they are always um, fueling takeover speculation, right? There's always people saying, including me, maybe Shell will buy BP. I don't know. If Shell buys BP, that would be a fantastic thing for BP. It'll be a lag or a drag on Shell for a while, but in medium to longer term, that'd be a pretty good thing. How about Eco Petrol? So the bullish thesis here is a stable production target. That's always good to know. It's very diversified and it has energy transition investments in renewables. The reason why I put that in orange is because this could be bullish energy transition investments, but it could also be bearish. So even though it comes up on the bull thesis as a summary from the analysts, I would say this kind of also could fall into the category of unknown. The more they invest in renewables, the more it costs them and the lower their production actually becomes. So as things stand right now, this is not very bullish. This is actually more sort of like unknown. It has a very high dividend potential in this current commodity super cycle. It's undervalued. Its PE is only sort of around 5 or so. And there's lots of growth opportunities. On the bearish side, you have the Colombian government. And I think, if I remember correctly, Colombia is going to have an election in 2026. So who knows what will happen to Ecopetrol and anything related to Colombia going into 2026. Maybe if there are some people from Colombia who are watching this video, you can tell us and educate us in terms of the upcoming election. If I'm correct about that, if I'm wrong about that, then just let me know and tell me it's not in 2026, but I think there's an election coming up. But there's profit and dividend pressures as well. There's high debt from transition acquisitions that relates to this energy transition investment in renewables, right? There's high debt. You, man, it costs a lot of money to get into these wind farms and solar farms, and wind turbines are awful generators of electricity on a global scale, and they are environmental destruction agents. But yet there are still people who buy into it. Ecopetrol also has slow growth versus its peers, and the management is in turmoil. And there's lots of instability with all the government interference. It's kind of like Petrobras, right? So it's a nice segue into Petrobras. So what is bullish on Petrobras? It's dominant for sure. Brazil's world-class pre-salt fields and low lifting costs. Um, in mining, we call it an all-in sustaining cost. And for the lack of a fancy term like that in energy, we'll just call it a break even. So Brazil's Petrobras has such a low break even that it's a very, very profitable company. It's got strong production growth and capex focused on high return projects. It's got a very attractive valuation with its low PE and an enterprise value of around 4x. High dividend yields, sometimes they're in question, but at the end of the day, they've been paying them, so they've been doing well. And then on the bearish side, significant political interference as a state-controlled entity leading to, in orange once again, potential dividend cuts. The reason why I put that into sort of unknown, if I could sort of position it that way, is because as a state-controlled entity, the largest shareholder in Petrobras is the government, right? So on one hand, they want to cut the dividends because they say the energy belongs to the people and the people should be benefiting from low energy prices as they should, so that's a very worthy cause. On the other hand, the state is the primary shareholder in Petrobras. So as long as Petrobras keeps paying high dividends, the state gets a lot of money. And if there's one thing that politicians like more than almost anything else, it's money, right? So as long as Petrobras keeps paying high dividends, there would probably be somewhat restraint from the government from an interference point of view, as long as they can keep receiving those big, fat, juicy checks. Exposure to volatile oil prices, this is true for everyone, and currency weakness in the Brazilian real. So the currency weakness is unique here, or perhaps more unique to Colombia and to Brazil than what it is, for instance, to the European super majors. Rising capex and debt for growth projects plus permanent valuation discount versus peers due to governance concerns. This comes back to Brazil as a geopolitical risk, in addition to the fact that Petrobras is a state-controlled entity. How about Shell? Can it get any better here? The bullish thesis on Shell is consistent $3.5 billion quarterly buyback and progressive dividends with almost 5% yield, robust free cash flow, and a 40 to 50% payout target, earning stability even in a lower price environment. This company is absolutely awesome. On the bearish side, they have thinning production outlook unless they do some acquisitions, right? So this is not dissimilar to many of the companies whose primary rocks are in the Permian Basin in the United States, for instance, like Occidental Petroleum. If they don't look to do some acquisitions or something, they are sort of depleting their assets. So the thinning production outlook applies to Shell too. They need to do some acquisitions, and they have been doing it. And as they've been going along, they've been doing a really good job at it as well. Weaker refining margins, high payout reliance on stable and high commodity prices. Once again, applicable to everyone, right? If you don't have high commodity prices, it becomes very difficult to do buybacks and to pay dividends and things like that. But so far, so good. They haven't skipped a beat. Governance headlines, well, Shell, like any European style super major, especially as it relates to oil and gas, is always in the news for the wrong reasons because they are always having audit probes and government investigations and all kinds of things. So that happens, and they just have to deal with it the same way, to a lesser degree, companies like Chevron and Exxon also have to deal with it in the United States. How about Total Energy? So Total Energy is the last one of the five. The bullish thesis here is balanced growth. It's actually looking pretty good, 3% annual gas and oil production plus rapid electricity expansion. That's a good one. Integrated power business, a strong free cash flow. They're predicting about $10 billion by 2030. Disciplined net investments, consistent $2 billion quarterly buybacks, a 6% yield. How beautiful is that, right? So you can sock away this 6% dividend yield or thereabouts while you wait for the commodity price to recover, which it will. And they have low debt as well, which is a good thing too. On the bearish side, oil and gas are vulnerable to lower prices, as it is, like I said, for everyone else. While renewables and power scaling carries execution and capex demand, there it is again, right? If you want to invest in renewables, which they have to do because they're French, then they have to also have the commensurate risk of the execution and capex demands. That will pressure the balance sheet, especially if commodity prices soften more, and there's geopolitical and regulatory risk as well because of the diverse geographical portfolio that they currently have. So here's my ranking, right? The most critical thing here is to say this is my ranking criteria, which might be completely different to yours, right? So you can see at the top of the page here what I used for ranking criteria in order to arrive at my number one, which is Total Energies. It's the best overall. It's got the strongest balanced portfolio. I particularly like the 6% dividend yield. This is one of those foundational stocks. If I were to buy Total Energies, I would sock it away in my investment portfolio where I keep my forever or permanent stocks. Buy it preferably when it pulls back a little bit just to make me feel nice and warm and fuzzy because I got a lower price, so I got a deal when it was on discount. And I will sock away that 6% dividend until the oil price starts recovering. And then I'll benefit from stock appreciation as well as the dividend and add the two together for hopefully about a 15% return per year, which compounded means I can double my investment every 5 years. Shell comes in at number two. This is a very strong peer leader. You could buy almost either of these, and if you don't want to buy either of them right away, then you buy them both, just a little bit of each, right? So you don't jump in boots and all on anything. LNG trading dominance drives stable cash flows and aggressive buybacks. I mentioned that, right? $3 to $4 billion quarterly with a 5% dividend yield. This is a great company. These two are an easy number one or two, and they could easily trade places as well, with Shell going to number one and Total going to number two. But based on my criteria, Total is the winner. Three, four, and five. At number three comes Petrobras. This is, and I've said this many, many times before, for the people who've been watching my videos for a few years, Petrobras remains probably the cheapest super major that you can buy. The problem is it comes with so much geopolitical risk and government interference that you never kind of feel secure in your decision, right? So you just don't know where you are until you get the next dividend check. Then you feel all happy. And a few weeks later, you unfortunately are less happy once again because there's so much stuff going on all the time, which is not good. But it does have an ultra cheap valuation. If you are not risk averse, you can buy Petrobras and just sit on it and earn those very, very rewarding dividends. Hopefully, nothing terribly bad happens to Petrobras. Ecopetrol is similar, right? Solid, but a riskier emergency market, EM, emergency market value. Attractive, 11 to 14% free cash flow and dividend yields. Diversified, higher political and management risks in Colombia, way more than the Petrobras upside. I think the reason for that comment is also because of the upcoming elections. But as I said at the start, please correct me on that one if I'm wrong. BP is just lagging execution. Nobody knows exactly where BP is going, except maybe that it might be going away because it might be getting acquired. I'm not sure. If you know more about BP than me, let us know in the comments. A decent yield, I mean, it's not decent, it's pretty good, right? Historical underperformance versus peers in it. Takeover speculation highlights standalone challenges, the lowest rank among the European super majors. So here's the thing that I said at the start, right? So how you can mitigate single stock risk, because obviously everyone who's watching this has a different criteria for their investments, and not everybody wants to take a chance because how about you pick the wrong one, right? So let's say you buy something like Ecopetrol in Colombia and it just crashes. That'd be awful, right? So, how do you mitigate that single stock risk? So, what I've done here is I've taken two of uh, of the ETF. So, ETF is an exchange traded fund, and I've taken two of the most popular ones. In fact, I own both of these. I almost view them as a parking lot, right? XLE, I've made many videos about, and I've included it in many videos before. IXC, I haven't spoken about much, but I've included it in this one because the difference between the two is XLE is predominantly US super majors and IXC is global. But you can see there's an overlap, right? So if I look at the top holdings in XLE, just Exxon and Chevron alone make up about 40% of this particular fund, right? So close to half of the fund is Exxon and Chevron. There's nothing wrong with that. If you don't know what to buy and you want to buy one single stock, you may as well just buy Exxon. Well, it's not just me who says that because IXC's fund managers agree, and their top holding is also Exxon, and their second one is also Chevron. So you got almost 30% in IXC, Exxon and Chevron, and 40% in XLE, Exxon and Chevron. But here's where it diverges, right? So the rest of the companies here are all US companies, whereas in IXC, some of the companies that I just talked about and some of the companies that I included in the previous video, which was Canada's top energy buys, are included here. So here you have Shell and Total Energies. There's Enbridge, which I covered in my Canadian video. There's BP, which we just talked about. There's Canadian Natural Resources, which I covered in the previous video, along with TC Energy, right? And these ETFs give you an opportunity to buy sort of the best of the best. But remember, an ETF also costs you a little bit of money. So let's just compare the two quickly so that you know where you are, and then I'll wrap it up, right? So these are passive ETFs providing exposure to large cap energy stocks. So you can say, I don't know what to buy, Rudy. So what I'm going to do is I'm just going to buy XLE, in which case I would say maybe what you want to do is take the money that you want to invest in XLE and split 50-50 between XLE and IXC. Then you get some US super majors, including Exxon and Chevron, and you get some global super majors, including Chevron and Exxon, Shell, Total, etc. They have a high overlap, as I just mentioned, and these two ETFs also pay a dividend of between 3 and 4% on an annualized basis. So by buying the ETF, you're not even giving up the dividend, you still manage to get a dividend payment on a quarterly basis. The key differences between the two, XLE is US only, whereas XIXC, XLE is US only, IXC is global. XLE is almost 10 times larger, more than 10 times larger than IXC. But here's the kicker. XLE has a very, very low expense ratio of only 0.08%, whereas IXC is charging you almost a half a percent. If you think that's nothing, you can calculate if you want how it compounds. If you don't know how to do that, just Google it and say, calculate the compounding of a half a percent per year for 20 years, see what you add up to. XLE is more concentrated and IXE is more diversified, not only because it has less Exxon and Chevron than XLE, but also because it has all those strong global stocks. In strong US energy cycles, XLE often outperforms. On the other hand, IXC offers geographical diversification, which is a potential hedge against US specific risks like policy changes, which includes having a new president, for instance, every 4 years, whereas in friendly dictatorships like France, Emmanuel Macron can sort of just engineer his presidency forever, right? So there is a difference in terms of how the systems work from a political point of view, and that geographical diversification is not necessarily a bad thing, right? So where we are at is I've provided you with coverage in terms of US energy super majors. You might say, which one of those should I buy? For me, the answer would be almost quite simple. If you want to avoid buying a master limited partnership, and I mentioned a couple of those, then you can just buy Exxon. In Canada, the super major that you can just buy and sort of set it and forget it and put it in your portfolio as a permanent stock is Canadian Natural Resources. And from a global perspective, I would do one of two things. I might look to say add Shell or Total Energies. Those would be my number one and two. Or otherwise, I'd say if I want to mitigate the single stock risk, I might add XLE and IXC, or one of the two ETFs in terms of just mitigating some of the risk. So that's a wrap on this one. I sincerely appreciate the fact that so many people have watched my previous two little videos. And if you're still with me right now, that's just awesome. I do appreciate it and I appreciate your attention very much. Thank you for sticking with me. Thank you for watching. Enjoy your New Year's celebrations as we go into 2026, and best of success to all of you with whatever it is that you do from your investment portfolio management point of view going into the new year.